Good afternoon. Good afternoon. It's Monday, the 6th of April. Welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe, the head of research for Maybank Securities here in Singapore. Now, the oil shock is not abating, and President Trump is threatening even more escalations to get the Straits of Hormuz open. Now, when the oil will flow, we have no idea. But in investing, it is our job to look for opportunities, whatever the circumstances are. So that's what we are going to do today. We're going to look at how to survive or how to navigate this oil shock. We speak with our head of sustainability research, Jigar Shah, on how this shock is driving energy security as well as what this means for electric vehicles. Then we take a closer look at Malaysian banks. Desmond Chung has got a new piece out on second, third derivative impacts on the sector and what that means for winners and losers. And higher oil prices are also driving or potentially can drive up CPO or palm oil prices as well. We've got a new piece from Chi Ting Ong looking at some of the winners there as well. Plus, we got some fresh charts from our chart guy and also a very special guest looking at CFDs and Maybank's offerings there. So a lot to cover in our show. So let's start with Jigar. Jigar, welcome to the show. Now, oil prices are up nearly 80% this year. Now, before we discuss the current oil shock, let's look at the last shock resulting from the Russia-Ukraine war in 2022. Jigar, what were some of the major shifts that you observed during this time, and what are some of the key takeaways that you observed for the current shock?
So thank you, Thilan, for inviting me. As far as the Ukraine war in 2022, the 40% of gas supply to the European countries got affected. And as a result, in 2023, the European Union added 40% more solar panels. And since then, a steady pace of addition has continued, and the whole world has added 3 times more solar PV capacity between 2022 and 2025. So that is the impact of that Ukraine-Russia war and the gas supply shock, which primarily came to Europe, but it was felt by many other countries as well because the gas prices shot up, and it affected the transition in the emerging and developing countries which were banking upon a cheap gas for a transition.
Understand. Now, you mentioned EVs as critical in terms of keeping emissions in check. Now, can you contextualize the role transport plays in terms of overall emissions and how EVs can mitigate some of the negative impacts?
So coming to cars in particular, there is a 80 million number of cars sold roughly every year. And when we take the trucks into account, two-wheelers and other vehicles, uh, the the overall emissions by the automobile sector, and of course we have to take into account aviation and shipping, is about 24%. So transport emissions are 24% of the total emissions, uh, and as a share of the total emissions. And then if we see the passenger vehicles and cars in particular, they would be about 11-12%, which is very substantial. And it is possible to electrify because of the advent of the batteries and the battery technology getting better and better, the learning rate of battery technology improving, reducing the range anxiety, and also costs coming down, falling substantially. Just to give you a data, the EV penetration was 5% in 2020, and by the end of 2025, it is 25%. And almost 39 countries in the world have more than 10% electric vehicle penetration. and this is more than what is there in the US. So clearly, EVs are helping uh, uh, take care of the pollution, the emission, as well as they are helping remove the energy insecurity, which is caused by this type of energy shocks, which is why I think they are becoming important. And I think every country is having a certain amount of corporate average fuel efficiency standards as well as the CO2 emission reduction standards, and those are all indicating towards improvement in the next 5 to 10 years, and perhaps phase out of the IC vehicles between 2035 and 2040.
Okay. So now, in your report, you analyzed 22 global automakers and also five shared mobility companies, so companies like Uber and so on, and their transition pathway. What are some of the key highlights that you observe? Which companies there are leading, and also which companies are lagging?
So let me tell you the most important finding here. It is that between 2020 and 2026, we compared the 22 automakers, which are roughly fulfilling 95% of the total vehicle sales at a global level. And these are uh, also consisting of about almost 4 gigatons of annual emissions. Now, when you see the market capitalization of these companies, it has gone up from $1.7 trillion to about $2.5 trillion in the same time period.
Mm,
What is interesting to notice is that when we combine the scope 1, scope 2, and scope 3 emissions of these companies, the scope 3 emissions are 99%, and scope 1 and 2 are only about 1%. And within that 99%, almost 75% is coming from the use phase emission of vehicles, and about 15 to 20% is coming from the supplier emissions. So the companies which are very efficient at managing this are the companies which have got electric vehicle and hybrid vehicle transition better than others. And these companies have a lower emission per vehicle. So if you see, the average is about 50 tons per vehicle, whereas the good companies or the ones which are better aligned to electric vehicle technology, they are between 30 35 tons per vehicle sold. And these companies are also, by the way, capturing the maximum incremental market capitalization between 2020 and 2026. So almost two-thirds to three-fourths of market cap is captured by Tesla, about 15% by BYD, and the rest by the Chinese automakers. Very little has gone to some of the other automakers in the region, could be a little bit for the Indian companies, a little bit for Koreans, and the Japanese automakers, as well as the European automakers, have been huge losers in this time period because their transition hasn't been swift enough. However,
mm.
having said that, we have provided granular details of their transition planning, which seems to be very, very strong going forward. And it appears that in the next 5 to 10 years, there's going to be a lot of catch up that will be at play, and a lot of these companies will up their game and transition. And this particular oil and gas shock in the Middle East is only going to accelerate this transition in our view.
Yeah, actually, I noted in your table, Tesla, BYD, and Xpeng saw some of the biggest market cap increases over that 5-year period. And I also noted that Tata Motors in India also has seen quite a big increase, although the share price has been fairly weak recently. So I think from a catch-up phase, maybe this is also a stock to kind of watch out for.
Absolutely.
Thanks, Jigar, for joining us. With that, we're going to move
Yes,
on to
Alan.
the Malaysian banks. Now, our banks analyst there, Desmond Shing, is maintaining his positive outlook on the Malaysian banks, with the sector entering current oil-driven uncertainty from a position of strength, supported by a stronger balance sheet, improved asset quality, and higher capital buffers as well. Our top buys in the sector are RHB, AMMB, and Public Bank, where there's valuation upside and sustainable dividend profiles, and also a compelling valuation relative to peers. Now, we think that elevated oil price do not necessarily derail Malaysia's economy. With historical precedent, if you look at 2011 to 2014, also which went through a similar sort of shock, GDP growth going into this year fairly resilient, stable banking sector performance despite crude prices hitting over $100, especially during the 2011 to 2014 period. We know that current macro conditions are more favorable than even that cycle. GDP growth pegged at about 5%, low inflation around 1.4 to 1.5%, firm currency. So all of that implies that the sector has and the economy has sufficient buffers to absorb shock. A key risk is the potential for oil flows to be disrupted via the Straits of Hormuz. That's something we're watching, and that could weigh on overall global growth. But there could be a faster resolution as well. We've seen Malaysian ships and so on are being allowed to pass through the straits. Now, one of the things Desmond has done is he's stress test scenarios, and even across those different scenarios, like high interest rates, lower growth, higher NPLs, overall earnings declines are manageable, about 7 to 15%, and return on average equity kind of remaining fairly resilient at about 8.5 to 9.5%. So in terms of downside, fairly resilient even at these stress levels. We also assess that dividends will remain fairly intact, with most banks still delivering more than 4% yield, even under stress situations. And names like CIMB, BIMB, and potentially RHB can actually still deliver above 5% dividend yield. So fairly defensive going into this stress cycle. So do look at the note today in the newsletter. You'll have a lot more information there. Now over to Plantations in Indonesia. With a new report from Chi Ting Ong, we're maintaining our neutral call on regional plantations. While I think there is this opportunity for a short-term trading stance, given all the impact in terms of oil and pricing visibility. Indonesia is proposing to move to B50, which is mixing the amount of palm oil to be mixed into to a liter of diesel, so 50-50 mix from the 1st of July. And this is supportive of CPO prices. Higher blending would result in lower oil imports into Indonesia and also help with managing the FX reserves as well. Now, there is a challenge though. The challenge is that B50 could be constrained with a methanol shortage because biodiesel production needs methanol, and domestic Indonesian supply is insufficient. So some of that methanol gets imported from the Middle East. But even with that, the government can stagger some of that implementation, and that will continue to provide some upside to CPO prices. Right now, our 2026 CPO average selling price forecast is about 4,100 ringgit per ton, although there is upside to this forecast if oil prices remain above $100 a barrel. On stock picks, our preferred buy ideas are Saimda Bigatri and Sarawak oil palms, and Genting Plantations is now being added to this list given its laggard and catch-up potential. And if you are looking for higher leverage to palm oil prices, so more of a trading view, TH Plantations and Genting Plantations would be the most sensitive to stronger CPO prices. So do have a look at our note there as well. With that, let's turn to our chart guy and a couple of chart ideas there. We've got DFI retail Stock is now building a new base, suggesting it could be a precursor to the next leg higher. So our chart guy has a trading buy on DFI retail. We got a trading sell on AEM holdings. The previous bullish run has entered an overbought state. Do have a look at more detailed technical analysis in our report. With that, let me also bring in our head of client engagement, Alex Ferber, to the show. Alex, welcome to the show. You're going to talk about some CFD products and so on, and you also want, and we think that, we'll have a closer look at the technical analysis of the S&P as a starting point. So, Alex, what can you tell us about the S&P from a technical standpoint right now?
Yeah, hi, Dylan. Thanks for having me on. So, yeah, look, the S&P managed to snap a 5-week losing streak on sort of cautious optimism around the Middle East, which is good news. But honestly, we think the bounce is more technical than anything else, and it's just recovering from oversold levels rather than a real shift in sentiment. So, for now, it's likely that broader bearish sentiment remains intact, especially with oil, both benchmarks, WTI and Brent, sitting stubbornly above the $100 mark. So, it's a case of continuing, I think, to watch the Middle East closely, but the downside risks haven't gone away. And if things do continue to go south, we're looking at support around the 61.70 mark, and then after that, potentially down at the 56.50 mark.
Got it. Now, Alex, a lot of our clients and viewers hold a portfolio of stocks, a mixture of Singapore blue chips, some of the US stocks, some Hong Kong stocks. Is there a scenario where a CFD index product actually complements what they originally owned?
Yes, there's definitely a case for it. The most practical use case is hedging downside risk. So if we look at recent market action, for example, the S&P is down year to date, the Nasdaq is off. The Nasdaq 100 is off, I think, 5-6%. So if someone has US equity exposure, they're going to find themselves in the red. So shorting a US index CFD like the S&P or the Nasdaq can act as a temporary buffer without disrupting the underlying on holdings. Unwinding a portfolio can be expensive. The short position on a CFD is a cost-effective way to offset a bit of downside risk. And because it's leverage, you don't need a lot of capital to put it on. Plus, it's low cost, you only pay spread, and it's super easy to unwind. Another use case, particularly if we have a client with exposure to Singapore blue chips, is filling those gaps they have in exposure. So, if somebody wanted broad market exposure quickly, for example, they wanted to look at Europe or Asia, without wanting to pick individual stocks, CFD and a regional index gives them exposure efficiently, quickly, with leverage and without the friction, of buying multiple foreign securities.
Yeah, so a lot more simpler way to trade than actually buying individual securities, and a quicker way to express a view, and a cheaper way to express a view as well. Now, but right now markets are very, very volatile. So is this actually a good environment, for CFD trading?
Look, yes and no. So volatility creates opportunity for CFD index traders for sure. Index CFDs will react immediately and fluidly to macro events. So when geopolitical tensions spike, as they have done, the indices will tend to move quickly and sharply in a clear direction, at least initially. So a trader who's anticipating, let's say, risk-off sentiment is going to drag indices lower, they can express that easily with a short on a CFD. Without needing to identify which individual stocks are going to be hit the hardest. So that's definitely an advantage. The volatility also brings bigger price movements. You need a little bit of volatility, particularly if you're going to day trade. So this is where leverage also works in a trader's favor. It can amplify the gains and make meaningful returns off a fairly small outlay. I think it's obviously also important to say that volatility does cut both ways. So, whipsawing can be a problem, particularly if you have an environment like you do now where headlines reverse fast. a ceasefire rumor, a tweet, and a position that was profitable in the morning is, underwater in the afternoon. So these conditions make good risk management essential as well. So we're providing a platform with all the tools necessary, like stop losses and conditional orders. So, it definitely creates opportunity, but clients need to be precise about entry points, disciplined about risk management, clear on exit strategy as well before putting trades on.
Okay. And Alex, before I let you go, how can our clients and viewers get more information about the CFDs we offer and trade those?
Yeah, so for existing clients, all you've got to do is log into the Maybank CFD platform and search for /MB Index. The product is already there. It's ready to go. You don't need to do anything. All you've got to do is look for it, and that will bring up our list of 19 global indices. So you can get exposure to the US, Europe, Asia, and also some specialist indices like the FANG index there as well. If you're not an existing client, then we've put the account opening link down there at the bottom, accountopening.maybank-securities.com.sg, or reach out to your trading rep or give us a call.
Great. And you can open an account with Maybank Securities by clicking on the top right of our newsletter as well. Thanks, Alex.
Thanks,
We're running short of time, so I just want to quickly highlight one big event tomorrow, 7 p.m. We've got Wedbush superstar tech analyst Dan Ives, along with Seth Barnum, Besham, their strategists, along with myself, talking about navigating geopolitics in the US and Singapore. So we're going to be talking about tech. We're going to be talking about Singapore large caps. We're going to be talking about oil and Trump. So a lot of discussions tomorrow. So don't miss out. It's a live webinar, seminar at 50 North Canal, but you can also join via web link as well. So do join up if you haven't done so. Unfortunately, that's all the time we have today. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.